Hi, CF Liu here from CF Liu channel. Now in this video, I want to show you how not to lose money in real estate property investing in Malaysia. And to do that, I want to actually show you two scenarios. Whereby, first scenario, you buy a property for investment from a property developer, let's say at 600,000. Okay, 600,000. That's it, right? No discount, no cash rebate, just fair price 600,000. The market price around the area is also 600,000. And then the other scenario would be where you buy the same property, but then on the sales and purchase agreement price, it was actually 1 million, but then the property developer actually give you a 40% or 400,000 cash rebate. And I'm going to give you these two scenarios and compare the difference, right? Which one is likely to make you money in the next 10, 20, 30 years? Which one is likely don't? So to start off with this, let's just imagine scenario one, right? Scenario one, like I say, just imagine, we have to make some assumption to make this calculation easier, simpler. Is that I'm going to ignore all renovation costs and all other sunk costs, like the cost of real property gain tax when you actually sell your property, real estate agent fees, renovation costs, and all these back end or front end, all the costs involved. I'm going to just ignore that, right? Just ignore that. But you know that that is not practical. But then, for the sake of the point I want to make, these other sunk costs or renovation costs and what other costs is involved is not significant compared to the point or the loan amount or the property value that you are buying. So in this scenario one, just imagine you go to a property developer, you buy a 600,000 property, which is again today in 2019 it should be considered as a mass market property. So imagine you're not even taking a 90% loan, you're taking a 100% loan, just to simplify the calculation. Okay, now just imagine you probably earn at least 10,000 net income per month. Therefore, when you buy a 600,000 property, you get 100% loan, and then the interest is about 4.5. Let's just assume 4.5. So what you have is tenure is also equal to 10 years, right? 10 years. Then you say, why 10 years? Just stay with me why I choose 10 years. Because 10 years is almost unheard of, right? Even though if you are you always want to stretch your monthly duration, the duration of the loan, to as long as possible, so you lower your monthly duration. But as you know, that costs you to pay more interest. But just imagine, stay with me, 600,000. You just say that, all right, I'm going to just pay that for 10 years, right? And monthly installment is about 6,000 too, which is okay, manageable, no problem. Okay, no problem. Okay, if you earn 10,000 or more per month, even 8,000 more per month. So what happened is that in this scenario one, you will end up paying about 146,000 for the next 10 years from today to the bank. So just make a note on that. In scenario one, you would be paying 146k of interest. It's going to font and make it maybe a bit smaller. Okay, but in total you would have paid 746. In total, 746k total you paid to the bank in scenario one. Now how about scenario two? If you just imagine, if you were to have the selling price was a 1 million, again, just 100%, right, a margin of financing. But I'm not going to take 10 years anymore, because if you say 1 million, then the bank is going to approve you based on 1 million of selling price, even though you have cash rebate. But the bank, when you submit application, the bank is going to evaluate you based on your debt service ratio, based on your purchase price. Now to actually talk about this, to have me explain more about debt service ratio and to a certain extent about loan compression, just click on what is popping up on the upper right hand corner, should be over here. So you actually later you can actually go to that other lesson of mine to understand what is loan compression and debt service ratio. But I don't want to actually confuse you, just jump right back into here. Now it doesn't make sense if you have you buy it at 1 million valuation and you get 100% margin of financing. which means 1 million loan, it becomes 10 years become like 10,000 per month. Doesn't make sense. So normally what people will do, and this is where you get a 400,000 cash rebate, right? So actually the property could be just like 600,000, but because you ask for 1 million kind of purchase price, and you take loan out of that, you got 400,000, woohoo, free money. And then what happened is you are going for, let's say, 30 years, and then we are going to calculate that again. Now this very manageable because every month you still only need to pay like 5,000. Okay, so 5,000 here, and scenario 1 is about 6,000 something. Again, doesn't make a lot of difference. But when it comes to total payment over here, it makes a lot of difference, because in this arrangement you are actually paying 824k interest to the bank, and in total you would have paid 1.8 million in total of a loan to settle the loan plus the interest, even though your loan actually is 1 million in the beginning, but you're actually paying like 800,000 interest over a period of 30 years to the bank. Okay, now here's the killer part, right? Now just imagine the valuation, the fair value of that property, the fair value of that property at the point when you purchase it is 600,000. So in scenario 1, you are actually buying that. Imagine you're buying that at a fair value per market price. So it reflects the market price. No discount, no fancy thing, no excessive or ridiculous fancy marketing tactic of cash rebate and all that. So just it is what it is. However, in the second arrangement, a property developer can actually give you 400,000 cash rebate. So 1 million and go 400,000 cash rebate, because the actual value of the property is only probably like 600,000. But you are taking another 400,000 of extra loan. Now this is not free money, because ultimately you still need to pay like 4 point something interest per year out of that loan. So it's not free money, although it's sitting in your account, and you are the one that actually need to bear this. Now jumping back right into here, if you have a fair value property price at the point of you buying it now is 600,000. Let me ask you, in 10 years, you would have paid the bank, settle your loan plus settle the interest of 746,000. So if in 10 years, in scenario 1, if you were to even sell it at 800k, or even more realistic, maybe at 1 million, actually if you compare what you have paid for the past 10 years, let's say 50,000, you sell at 800,000, 1 million, you already actually make a money out of that. Okay, make sense, right? Makes sense. So even like, for example, you could actually sell it at 750, so let's say minimally you can actually only able to sell at 750,000. This is just break even with your total loan pay, right? Total loan that is paid for the past 10 years. Now, what you need to do is that at the point of entry 600,000, you just need this 600k to actually appreciate to 750k in 10 years in order for you not to lose money. As simple as that. So let me ask you, a property appreciation price of 150k, okay, in 10 years, that is equivalent to around 150 in 10 years, so that's equivalent to around 150k over your original price 600k, which is around 25% of appreciation in 10 years, which is quite realistic if you think about it, right? 25%. So 1 year you need to appreciate about, like 2 point something percent, which is very doable, and that's how you don't lose money. Now how about scenario 2? Now scenario 2 is that you have to look at the fact that in the next 30 years you would have paid close to this 1.8 million total, and I have not really included in all the renovation costs and all incidental costs. This easily can add up, all the legal fees and all that easily add up. It could be 2 million, but I'm just lowballing it here of 1.8 million. So, and you know that in either of this arrangement, whether there's a 400,000 cash rebate or not, the property, it doesn't change the fact that the property value is actually 600,000. Okay, 600,000. So when you have like 600,000, okay, at the time of purchase, now in the next 30 years, you would have paid 1.8 million. So I would say that now your hurdle is bigger because 600,000, you would have need the property to go to 1.3, 1.8 million in 30 years for you to actually just break even, disregarding all other incidental costs, which actually practically you can't, because there's always this sunk cost, right? So 600,000 to 1.8 million property value, that is like 300% of appreciation, or 3 times, although it's in 30 years. So every single year, can I say approximately, just do a simple average without compounding, 300% in 30 years, you divide by 30, every year probably you need like 10% appreciation, or the property actually, the property actually appreciate 10% per year. Now that is a lot, and that is not easy to do, but that is the fact that you need in order for you to only break even. Okay, and then the other things come, the other problem comes, because for a property in 10 years time, a property of 750,000 is another one. It's probably still very affordable, or 800,000. But in 30 years time, again, I don't know what's going to happen in 30 years, but as what we can feel today, just just a property, maybe an apartment or condo that costs 1.8 million is unthinkable. Maybe that is very common at that point of time, but here's the fact, right? Who wants to pay actually 1.8 million for a property that is already 30 years old? Think about that. Property at that point of time might cost 1.8 million. Yes, that's fine. Inflation, yes, I understand. But can you imagine, if people have 1.8 million, they would rather buy a newer property at that point of time, 30 years, which has, I don't know how the world will actually change, whether you and I are still here or not, whether there's any world war, even like World War II, see? Right? So, and I don't want to even talk about like whether in the next 10, 20, 30 years, whether your rental cash flow will be positive or negative. If it's negative, then it will be a double whammy to this calculation. Okay? And of course, when you say that you have like 400,000 K of cashback, you can say that, oh, I can use that money to roll. Fair enough. If you really know how to, let's say that 400,000 is a cash, right? But the interest, I mean, if you're just going to put that back in your loan account, that reduces the outstanding principal of 600,000, which the 4.5% is charged on your 600,000 loan and reducing, rather than 1 million loan, which is fair. Okay, which is fair. But then again, you are not really, again, that doesn't make any difference if you were to actually buy this property following scenario 1. Just buy that property, 600,000, no fancy thing, no fancy cashback, no fancy discount, just go there, right? But for most people who actually want to take out this 400,000 K of cashback, they are going to use that for something else, right? Now, unless you could actually generate return out of that 400,000, which is at least double, okay, I guess double or higher, or even 2-3% higher than what the interest out of that 400,000, which is 4.5%, then that would be, there will be a lost opportunity cost over there. Now, for very easy way to actually get at 6-7% per annum very consistently, this is how actually people are playing this game. They're actually putting that cash rebate in a very stable instrument, which is called real asset investment trust, REIT instrument asset class. Give you 6-7% very consistent every year. They're just going to put it there, liquid enough. Anytime they spot where a spot opportunity or situation and need to use the money, they can actually withdraw the 400,000 or partial of that 400,000, actually do whatever they want to do. So to really understand how people actually play this, utilize real estate investment trust or REITs as a temporary parking place for their cashback amount from buying a brick and mortar property, just head on to click on the description below, or what is shown below, go on to REIT method, and then you just join a webinar, and then I'll actually, it's totally free, give you insights of how you can do that, how a very informed property investor actually doing that. So it's about shifting your money around, right, to something that is still property backed, property correlated, but it's liquid enough so that it can sit there before you actually use that or partial of that money, 400,000, and actually make a big purchase. So just check on that. Links description below, or just go see below this video on this line, right? So I'm just coming back to here to tell you now it has to make sense, right? Scenario one for me, it really doesn't make a lot of sense because again, I say property needs to appreciate by that much, about 1.8 million in 30 years, just so that you can actually break even. Because a lot of people forgotten in the 30 years how much they would have paid and how much your property would need to actually appreciate in order for you just to break even, which is why people say that why I can't feel my property is making money, but then they fail to actually see this angle of things. They say that okay, ultimately I will make big money, I will make big money, I will own the property, I will have positive equity, right? At the end of the day I can sell it, but it's very hard to actually sell this property maybe in 30 years. One is because it's old, second is because for that value they can buy a newer property, and the fact they forgot over the past 30 years they have paid more than double, almost double of what is the original loan amount that they have. Now just imagine, just compare that to again 600,000. If I go to put like 10 years, you know that the interest is just probably a fraction of the total pay. But if you were going to do this cash rebate or cash rebate, and maybe coupled with loan compression, that is where really doesn't really make sense. What do you think? Now I want you to poke holes into my this insight or perspective. Maybe you have other opinion, which I welcome you to actually disagree with me. So that's why I want you to actually post your comments in the comment section below and see whether I missed anything. If there's any insights that you would like to share with me, and I'll be happy to actually look at what you have to say, what you think, and what is your perspective, or if you're in a similar situation, right? Or has this perspective ever surfaced in your mind at all? So just go to comment section below, just type in your comments, and if other than that, if you think this lesson has been useful, click on the like button. Just click on the like button. I really appreciate that. It will really help to actually help more people to get smarter in their property investing, should they actually still want to embark on this. Now click on the notification bell as well, so you get notified when I post more useful lessons like this. Now that being said, I'm Seth Liu, and I'll see you in another lesson. Okay, you take care.